What if the venture capital industry has been thinking about value completely backwards?
Water is a commodity to me right now, but if you don't have access to it, it suddenly becomes the most valuable resource in the world. And that's the same for capital.
While most investors chase crowded deals, one fund discovered something startling about where real opportunity hides.
The world spends staggering amounts of money on healthcare. It's almost exclusively on treating people once they're symptomatic.
Trillions wasted on reactive solutions. But what if there was a way to profit by fixing the system itself?
So when we talk about shared value at Eka, we're specifically talking about creating economic value and societal value in parallel.
This approach led to something unprecedented in venture capital.
The vast majority of the time, when it comes to us putting that term sheet in, we are the only term sheet at that point.
70% of their deals had no competing term sheets. But even the best thesis means nothing without the right execution.
The single biggest driver of success is the founders and their ability to scale with their business.
So how do you identify founders who can deliver both impact and returns?
That pace with quality, it's like a cheat code on building a business.
Discover the playbook that's redefining impact investing. Catch the full conversation on the Impact Highlights series.
Welcome to the Impact Highlights series powered by EUVC, Impact VC, and Impact Supporters. I'm super excited for the conversation that we're having today with Jon. Jon Coker is the founding partner of Eka Ventures. Is very deep on everything related to shared value, founder assessments, and consumer health tech and digital tech. I had a really good conversation here today, but I really had three things that stood out to me. First of all, Jon talked about how he found his niche in the consumer health tech and climate tech space. Second of all, he talked about how impact is not a thesis in itself, and he really encourages other impact VCs and generalist VCs looking at impact to really find their thesis within impact. Third of all, Jon shared a super interesting fact. He said that out of their first fund, 70% of the deals they had, and they didn't have any competing term sheet. That's what I call true impact additionality. So I hope that was exciting. I hope you're as excited as I am. Let's jump right into it.
Here's a few words from our beloved sponsor. Impact VC is a global community of VCs accelerating impact within venture. Their purpose is to cultivate a community and resources to unlock venture capital's ability to tackle the world's most pressing challenges. The community is made up of over 900 VCs, including both pioneers and newcomers, including generalist VCs and impact specialists. Visit impactvc.co to join the community and explore their resources, including the VC Impact Playbook, the Founder Impact Playbook, and the Impact Investing for VCs online training, which is designed to help VCs integrate impact practices into their investment strategies.
That's a lot of information to get in 30 seconds.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
I'm super excited for today because I have Jon with me here today. We're going to talk about a lot of things from shared value to impact to founder alignment a little bit as well. So thank you very much for joining us, Jon, and welcome.
Great to be on here. I'm excited for the conversation and thanks for asking me on.
Yeah, super excited. But let's dive into you maybe a little bit first, going a little bit on the personal side and journey into where you are today. And do you mind telling us a little bit about yourself and what you do today?
So I'm one of the founding partners and general partners at a venture firm called Eka Ventures. We're an impact-focused investor. We specifically focus on two impact themes: consumer health and sustainable consumption. We're currently investing out of a £68 million fund one. I've made 21 investments at that fund so far. Before setting up Eka, I did an engineering degree a very long time ago. Went into the city for a couple of years, and then that was kind of 2007. And around about that time, electric vehicles were just starting to be a thing. Well, they weren't mainstream, but the Tesla Roadster you were starting to see them on the road occasionally. And then there was an Indian make of electric vehicle called Riva, and I think it just really kind of got my engineering kind of interest going. And it felt like they were the future. They actually, to be honest, like the core of that, we're going to come on to talk about it, but the shared value element of an electric vehicle like was really interesting to me. And so I was at JP Morgan at the time, and I started to research electric vehicles and where they were going, and realized that that's when I discovered the venture capital industry. Like I realized that there were these funds that were backing companies like Tesla and Riva. And so I started emailing them, not really sure why, like just to find out more information. And and that then really got me kind of increasingly interested. And so I actually ended up just leaving JP Morgan with a belief that I wanted to go into venture. And so that was probably end of January 2007. And I was lucky enough to meet the founders of a venture fund called MMC Ventures back then. And at the time, it was mainly an angel syndicate. So it was founded by 3 individuals who'd been angel investing and were kind of bringing together a team to help them source and find great companies. And so I joined there as an analyst, as one of the early employees. And then I ended up spending 11 years there and ended up as co-managing partner alongside one of the founders, someone called Bruce McFarlane. So that was my kind of journey into venture. And MMC was a generalist tech investor. And so I left there in 2018 and teamed up with my co-founder, Camilla Dolan, who had been working with at MMC for a while, 4 years. And we started Eka, and we started Eka with this kind of core belief that we wanted to change 3 things in the venture industry. So the first is this focus on shared value, this belief that there's an opportunity to build impact and economic value in parallel in certain elements of our economy. Second was a focus on consumer technology. It's what Camilla and I know. It's where we made money. And we believed there was an opportunity for some real impact through that. And then the third was a focus on founder development and a belief that we needed to kind of rewire the way that VCs were assessing founders. Yeah, and that was the beginning, and have loved every minute of it to this point. And yeah, now sort of scaled portfolio of 20 companies doing some incredible stuff. It's sort of come to reality.
Could you not have invested in impact out of the more generalist fund that the MMC Ventures was? Or why did you create Eka?
Yeah, I mean, so MMC does do a lot of investing in some of the themes that we invest in. They're slightly later stage than we are. I think that just the time was right for me to start a new fund. I'm still really close to the team there. They've done some incredible stuff since I left. But yeah, for me, it was the right time to start a new fund. And I wanted the kind of remit to be dedicated to these 2 impact themes. And so that was really the kind of core of it.
Why do you think today that these 2 areas of impact are where you can sort of create outperformance or top quartile returns? Is there a specific reason for?
Yeah, I think there's probably 2 separate but connected reasons depending on the 2 themes. I'll go into a little bit more detail about what I mean about the themes. So consumer health for us is all about a shift from a focus on a very treatment-driven healthcare system to a more like proactive and preventative one. The world spends staggering amounts of money on healthcare. I think it's something like $10 trillion. It's basically 10% of GDP of all the main countries. But if you look at where that money is spent, it is almost exclusively like 95% spent on treating people once they're symptomatic. And obviously what's happening is we have an aging demographic and we have rising chronic disease. And so having a system that only focuses on treatment means that the costs of that system are rising exponentially and there's nothing we can really do about it. And so it is not a new concept that we need to shift that to a more preventative model. When you think about what that actually means, it means getting to things before they become symptomatic. So engaging with people outside of the healthcare system, which inherently is a consumer, from a business model perspective, is a consumer. You're going to be selling consumer products, whether or not you're selling them directly to a consumer or whether or not you're selling them through other channels. The reality is that product and service needs to be engaging with a human in their daily life in a way that it doesn't if you're focused on selling your products into the healthcare system today, into a very clinical B2B style setting. We believe that requires a different type of investor. It requires an investor who understands consumer products and services And so that's, I guess, our reason for being, why we think that opportunity exists. And so if you look at the way that we invest in health, we are often co-investing alongside your typical kind of health tech investor, but we're bringing a completely different mindset to the business. So that's the reason, kind of the reason on consumer health. Consumer health, in the way that we define it, is a shared value theme. Like, if we can focus more on prevention, then we will have better health outcomes, better quality of life, less health inequality, and a lower cost of care. Like, kind of perfect shared value wrapper. And then sustainable consumption for us is all about, how do we move from very linear, carbon intense and wasteful supply chains in our big consumer industries to ones that are more efficient, more circular, and less reliant on fossil fuels to power them. And we believe those supply chains are just better, like, in every way you look at it. The cost will be reduced and the environmental impact will be significantly reduced. But we believe part of those, kind of that shift, needs an investor with a consumer mindset. Whereas if you look at a lot of climate tech investors, they're very focused on the kind of deep tech B2B side of things, whereas we're much more interested in the kind of application layer of these new technologies, whether that be in logistics with a company like Hive or the other areas that we invest in. So that's the two reasons we pick those themes. We think they kind of play to our skill sets and will create a huge amount of shareholder value and a huge amount of societal value over time.
I'm actually changing up my whole logic for what we were going to talk about here, but maybe just jumping a little bit on the health side that you're talking about. I've actually spent quite a lot of time in the health area from an insurance perspective in some of my previous jobs. And there's always a lot of discussion about whether they should really sort of, first of all, get people on the health trend early enough to actually avoid diseases in the end, but also just convince them that they should spend money from a B2C perspective, at least, to get into this. Then you can look at other distribution ways, of course. How are you seeing this? Are people ready to first of all, prevent diseases? And is distribution B2C at least possible in the UK/European markets?
It varies. So at one end of the spectrum, we have investments in companies like Runner, which is a run training app focused on getting people more active, basically. And that's a direct to consumer business that is focused on serving people who have never run before and are very inactive, through to people who are trying to go sub 3 hours in a marathon, right? So it's building a brand that caters for everybody. And we actually think that's important in that kind of, it's not, what they're not doing is saying, oh, we're sort of trying to help people who are, they're not building a brand that's focused on people who aren't good at running. It's kind of an aspirational brand for everybody. And they're having a huge amount of success through that. And one of the things we do at Eka is we track all of the written reviews on every single portfolio company, and the variation of reviews from people who thought that they would never get into running, who were completely physically inactive and are now hooked on it, versus those who are like saying, yes, I've just dropped 20 minutes off my marathon time, is kind of cool to see. I think there's a direct to consumer motion. And also, there's a big part of their plans, which are free, which are focused on getting people into running. So that's easier to do. Another element would be, we have an investment in a business called Flock Health, which is focused on physiotherapy and building a digital physiotherapist. They are distributing, it's a consumer app, like it's the kind of thing that you would expect to engage with if you downloaded it out of the App Store. It's an incredible product, but they're distributing that through your traditional health setting. So, people are referred to it by their GP. And so they're not reliant on the consumer paying, but that's important because in that category, in physiotherapy, there is a huge underserved group of people who can't afford to pay for physiotherapy. And those people are also most likely to have a job that is giving them back pain, most likely not to be able to do their job because they have back pain, and least likely to be able to afford private care. And so having the average wait time for physiotherapy through the NHS is 13 weeks. Having someone like that sat waiting for 13 weeks is a massive problem, and like Flock can solve that. So we think in our impact, when we think about consumer health, we think that distribution channels, You need to think really carefully about the distribution channels, especially with the perspective of impact.
I noticed when looking at your website, right, is that one of the first lines on your website is that we invest in founders creating positive system change. My question to you is, what does that exactly mean? And is that all impact startups that create that system change? Because now we talked about a couple of the ones you've already invested in, or how do you make that tangible in your work?
I'm going to say like a generalist comment and then I'll apply it to us. So I think great venture investing, not all venture investing, but the way that I think works for us, and I think you see done across the world really well, is thematic. So you pick a theme that you believe, you pick a change that you believe is going to happen over the next 20, 30 years, empowered by technology. And then you find founders who are building in that theme. Then if you think about what does that mean at a system change level, like our two themes are system change, like definitely. What we're looking to find is the best founders building companies that are the building blocks of that system change. I guess that's what we mean by founders building positive system change. Like we're looking for people who share our worldview and are building companies. I think what we need to be good at is identifying themes and finding great founders. What we don't need to be good at is finding great ideas within those themes. It's not our job to think what the building blocks are. Founders bring us ideas that are the building blocks, and then we invest in them.
When you're thematic, you can also still have some assumptions about what would be the best type of solution within a field. Do you not build those sort of hypotheses of this is the best within consumer health that we can look at right now? So how do you then approach it more so specifically? Is it all inbound, or if you would go out and do outbound and chase, would you then chase per hypothesis or more on a large theme basis?
Yes, it's a really good challenge. I think maybe I'll use another example to prove what I mean. So we believe that technology is going to enable us to diagnose disease earlier and cheaper. Well, you can only diagnose disease earlier if it's cheaper because you need population level screening. So let's say the kind of two go together. But yeah, so that's a thesis for us. So early diagnostics would be a thesis for us. And so we're interested in founders building into that. We have a data platform that finds about 50% of the investments that we make. And it identified a company called Oxford Cancer Analytics, which is building a early stage lung cancer diagnostic. Now, the team there shares the same thesis as us, which is it's important to move diagnostics earlier. But their idea is that they can use a technique called proteomics and combine that with machine learning to identify early stage lung cancer. Our thematic is early diagnostics. Their idea is proteomics, machine learning, and early stage lung cancer. Like we would never come up with those three things. We might come up with lung cancer, but we'd never come up. That's their job. They're the experts there. So I suppose that's what I mean. Like we have themes within the theme, but the core kind of technological innovation normally comes from the founders.
Maybe then taking a little bit of a stab at what we talked about, which is fairly specialized. I think we discussed a little bit beforehand whether you would see yourself as a generalist fund or more as a specialized fund. How do you view that, and how specialist do you need to be when you're an impact fund?
Maybe again, like step back, think about venture as a whole. Like if you think about where you can focus as an investor, you can focus on a stage. So you can be broad or narrow at stage. So you see some funds that will go pre-seed all the way up to growth. And then you see some funds that are super narrow on that. We're pretty narrow on that, right? We're pre-seed, seed. So, and there's expertise in that. So that's one area of focus. Second area of focus might be sector. There you'll see like insurtech funds or fintech funds or logistics funds, or you see these kind of very focused, and that's not us. So from sector, we're pretty industry agnostic. The third area I'd say is business model. So there you'll see enterprise software or SaaS or potentially AI, but I think that's a bit more, or consumer tech. There we're really focused. Like we like products and services that ends up in the hands of individual. And we believe we really understand that and those go-to-market motions. And then you have thematic investors. And typically, if you're a sector-focused investor, you won't be thematic. We're really focused on two themes. And those themes cover multiple sectors, but we're very focused on them. And then finally, you have geographical focus. So you might be an investor that focuses on the whole world, or you might be focused on a single country. And we're focused on the UK. We think that is important at seed. We think it's important to be a local investor at seed. So I guess depending on who you talk to, they will think we're very focused or not focused. If you talk to someone who's only focused on insurance technology, they will think we're super broad. If you focus on like a generalist investor across the world, they'll think we're super narrow. So I don't think impact is different to that. Like, we think we're pretty focused in the way that we invest, and we've picked thematically, that's where the impact plays. We're pretty focused on two themes.
Yeah, I think there's a lot of interesting things you said there. I think one point that I've actually not heard that put as clearly before is the difference between thematic and sector focus. Because often those are put sort of in the same bucket as one overlapping thing, but you're right, it is two sort of separate parts. When preparing this quickly, I also saw that you said one thing, which was that 70% of your investments that you made actually didn't have a competing term sheet. Can you elaborate a little bit on that point?
Yeah, so it's actually something that we kind of discovered doing the analysis, looking back on Fund 1. And our style as an investor is we really like to be the lead or the co-lead. We really like to be the first institutional investor. Typically, if you look at the majority of investments that we've made, we're investing £1 to £1.5 million in rounds of 2 to 3, and we're the largest investor. What we've actually found when we look back on it is that the vast majority of the time, when it comes to us putting that term sheet in, we are the only term sheet at that point. There's something that people use, a term that people use in the impact world called additionality. For us, that is a real sign of like, we have a reason to exist as a VC. What comes next from that, which is important to think about, is it's okay to be different on your first investment, but then you want your companies to be able to access capital in the next round. So you kind of need something to change so that they don't have a problem at the next round. And we have also like really good data on that happening. Like, our companies have a very, very good follow-on rate, have raised a lot of capital from great investors. So we kind of feel like we have this place in the market where we are different and it's really valuable. And I think there's a few parts that play into that. Consumer tech investing is not something that lots of people are doing at the moment. It just, for whatever reason, the industry is much more excited about like enterprise software or whatever it would be. And that's great for us because we think there's a huge amount of value there. And then I think the second thing is that we just, like, there's stuff that we will do that a lot of other, like, we quite like stuff that operates in the real world, like a logistics business or business that's helping visually impaired people navigate, like stuff that you can kind of touch and see and like happens in people's lives is interesting to us, but complicated as an investor. And I think that is different about the way that we invest.
Yeah, I'm thinking the stat is quite rare for the sector. Do you have a benchmark of the industry or not really? Because I was surprised to see the number.
Yeah, no, we don't. Yeah, we don't. I mean, I'm pretty sure it's high, but we don't have a benchmark on it.
Yeah, no, I'm 90% sure it's high, but I wouldn't know exactly what to.
And I think there's a really important kind of sub point with that is that if that's where you're playing, you also need to be very like kind of, that's not the same as saying that means that we can price wherever we want. Like, the founders that we're backing still give themselves options. They're just, we want to be like really, really fair in the way that we price the round. So I think that's also an important point. It's kind of like, this is a strange analogy, but a lot of people talk about the venture industry as being a commodity, like we're just selling capital and that's a commodity. But if you think about, maybe like, you use another analogy, which is water, like water is a commodity to me right now because it's here, I can turn the tap on. But if you don't have access to it, it suddenly becomes the most valuable resource in the world. And that's the same for capital. So we as a VC, in order not to be a commodity, you need to play in places where capital isn't easy to access. And so I guess that's important to us, because then we're valuable. Like, people talk about value add in VC. Well, the most value add you can ever do is be the investor that really believes in a founder when others don't, and believes in a way that they're prepared to put like really sensible terms on the table.
Especially as an impact VC, it's important, right? Because you said it yourself, right? You pretty much have additionality in two ways to companies. Either it's putting in a ticket at a point when nobody else wants to put a ticket, or then it needs to be throughout the holding period. You need to be adding extra value somehow that nobody else would have been able to give this company. Otherwise, you're not having impact additionality. Maybe jumping a little bit, because now you started talking, I would say, indirectly about shared value as well between the founder and you. Can you give us a little bit of a sort of a definition of what that is and how you use it at Eka?
Well, so when we talk about shared value at Eka, we're specifically talking about the process of creating like economic value and societal value in parallel. I always end up using food waste as the example, right? So, I mean, you walk into a supermarket and there's food everywhere, and something like 20% of that food is going to get wasted. 15%, 20% of that food is going to get wasted. And the reason that waste exists is because the supermarket can't accurately predict what it's going to sell that day. And so it kind of has this trade-off between the cost of food that it doesn't sell if it's wasted, and the margin of food it doesn't sell if it's sold out. And it's kind of got that equilibrium. With modern technology, you can shift that equilibrium. So you can become better at predicting what you're going to sell. And so therefore that trade-off changes a bit. You can have less food waste without giving up the margin. And if you do that, your economics improve because the cost of the food waste reduces for the same margin. So your bottom line improves, but so does your environmental impact because you're holding less food waste. And so that's that kind of double, like the two together, they're in lock, and that's shared value. So if you look at all of our companies, that dynamic's at play, whereby they are doing something that both improves the economics of their industry and the impact of that industry. And that's what we're looking for.
And maybe without mentioning any, but do you feel like there are some impact startups that are not doing that today, or that get venture backing, but that are not having that, I guess you call it a lockstep model between societal value and economic value? Or so how do you then assess it when you're looking at a company?
I would say that there is a really important, like hugely important part of the impact investing world where that doesn't exist, where they are looking like actively like kind of on a mandate where they will take a reduction in returns in order to deliver an impact. And that is really important. So I think there's that area, and I'm fascinated by that area, and it's hugely important. I think there's another area where you're investing and relying on some kind of demand trend to drive the growth. So it might be you're relying on consumers being happy to pay a bit more for more sustainable goods. That's not shared value. That's just kind of a demand trend driving it. Or it might be that you're relying on a regulatory change to drive a behavior which increases like purchasing in that area. That's also not shared value. We actually think that if you get the shared value bit right, you then access those demand trends. And so suddenly you have more demand plus better economics. And that's like a double whammy on the shared value. For us to invest, we need the shared value first.
Yeah, and I think you've done fairly well so far with that from what I could understand beforehand. Both seeing that I think in all the years you've invested in VC, you've backed 2 companies that have gone to become unicorns. I would say, are there any sort of business building lessons from those investments, or from the time you've done all the investments in these 15 years, and are there any things that you would both regarding to shared value, but also outside of the shared value model, that you would actually sort of really recommend people to think about when they look at investments?
The single biggest driver of success is the founders and their ability to scale with their business. When I think about the founders that we've worked with who've achieved that, like real scale in their organization, they have had this unbelievable desire to learn. And, there's probably a few different, without going into the detail of it, but they do just have this drive to kind of upskill their ability ahead of their business. So you think like their business is scaling really quickly, but they are scaling they kind of know that they're learning into where they need to be in a year's time rather than catching up and trying to kind of hold on. And that's really powerful. And I do think you can kind of develop, we believe you can look for that as you're investing. I think some of the behaviors that we then see in founders when they are on that journey is extreme clarity of communication, major bias for action. Like they make thoughtful decisions very, very quickly, and they have an incredibly high quality bar. And like those kind of things together, that pace with quality, it's like a cheat code on building a business, and you got to find it. And so, yeah, it always comes back to people for me. If you think about what we're doing now, the alignment with what they're trying to achieve is incredibly important to us. Like if you find people who are trying to do this are aligned with us in what they want to create, and they're creating it like I just described, that's really powerful. Hugely energizing. Like working with people like that it's just, you get so much energy from engaging with them.
I really like the concept of like scaling the founder at the same time as you scale the company. Did you create that concept, or is that something we'll do?
I don't hear a lot of other people talk about it, but there's the content that is being created around founding businesses is a lot to do with founders wanting to learn. So yeah, we just had a few experiences with founders where they were learning, they were doing stuff to learn that really surprised us, whether that be, an executive MBA while running a business. All those traits I just described, they do better than I do. And so, you kind of listen to what they're doing and you can't comprehend how they're doing it. Like you don't understand how they're running the business like they're doing and finding the time. It's not even finding the time. It's like having the discipline to carve out the time to learn. Yeah, I've just seen it 3 or 4 times in founders that have scaled huge businesses. And we then set up Eka to try and select for it. And we see it, a higher percentage of it in the founders we work with at Eka, which is really exciting.
And have you then sort of created a way to actually identify these early on? Because having been on the VC side myself, it's also hard to see if this person is really learning quicker than, or if X person is learning quicker than Y person.
Yeah, so we do have a process that we use. We put a lot of thought into what we do. I don't know if the process itself is particularly good at identifying development capacity, or it is the investment in the time and doing it over and over and over again that means that you then become better at understanding it. We do a process between, like before we go issue a term sheet or investment committee or kind of any kind of due diligence, where we focus exclusively on the founders. We ask them to take a psychometric test called Hogan, not because we have a view on what a good psychometric profile is, but because it really helps us then for the next stage, which is we have a 90-minute session with each of the founders where we ask them to kind of take us through their life and their experiences and talk about where they've excelled and what they've learned and the decisions that they've made. We learn a huge amount from that. And then we do really detailed references. And what we're looking for is awareness of their own, like, have they got really good awareness of where they're strong and where they're weak? Have they got really good awareness of how they impact on people around them? Have they got really good structures in place for learning? And then can they point to times in their life where they have rapidly developed and like outperformed? And that can be in any context. And actually what we see is that you often meet people where they've just done it 3 or 4 times through their life. And it could be in academics, it could be in sport, it could be in music, it could be in early business, it could be in anything. But they just have this ability to take something that's new to them and become very, very good at it.
And is that different for impact startup founders than more traditional startup founders? Or are there anything you would say that you need to think about when specifically looking at an impact startup founder?
The why, I guess, maybe, like, which we spend some time with them on, like, why are they building this particular business? And there's normally a story there that kind of points towards it. And that's important to us. The process of building a business is the same, as in the need to develop your leadership rapidly is the same in a generalist VC-backed business as it is in an impact VC business. You know, one of the key measures of impact is scale. There's depth and scale. And I think a lot of the impact industry forgets about the scale bit. These businesses will be impactful if they scale, but if they stay tiny, they won't. And so finding people who are up for building big businesses is important in a way that still maintains that impact.
If you were a generalist investor and you were looking at the impact field or impact VC field, what would be your best tip for that generalist investor?
So we've co-invested with a lot of generalist investors in our portfolio. And normally what happens is that one of our companies kind of is in one of their themes or sectors. So we have an investment in a company called Urban Jungle, which is in the insurance industry. And that has a number of specialist insurtech investors in it because they are trying to change the insurance industry. And that fits with what insurers-focused investors are looking for. And so I think if you're a specialist or if you're looking for particular things as a generalist, then kind of think through what's the change that technology is going to create, what's the positive change that technology is going to create in your industry, and then look for companies within it. Probably one of the other points that I make all the time is there's often confusion between impact and ESG. And so that is important. And so impact is what the company does, what the product does, and ESG is how the company does it. And both are really important, but I think the kind of delineation between the two and the way that you think about yourself as an investor is equally important.
Would that be a similar tip that you would give to another impact investor? I would assume that since they would already know some of these impact things, like what would you give as a tip to another impact VC investor?
It's difficult to give tips to other people because there are some great impact VCs out there. I think in general, VCs and impact VCs should think more about founders than they actually do. If you ask any VC or almost any VC what the most important thing is, they will say people and team. If you ask them, okay, great, how do you think about understanding people and team, normally breaks down a little bit. And that, I think, is something that the whole industry could benefit from changing.
Yeah, I think that's a good final tip and a way to round it off. Super, super interesting, Jon, and thanks you so much for joining the conversation. I really appreciate it.
I loved it. Thank you. See you soon.
Here's a few words from our beloved sponsor. Impact VC is a global community of VCs accelerating impact within venture. Their purpose is to cultivate a community and resources to unlock venture capital's ability to tackle the world's most pressing challenges. The community is made up of over 900 VCs, including both pioneers and newcomers, including generalist VCs and impact specialists. Visit impactvc.co to join the community and explore their resources, including the VC Impact Playbook, the Founder Impact Playbook, and the Impact Investing for VCs online training, which is designed to help VCs integrate impact practices into their investment strategies.
It's a lot of information to get in 30 seconds.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.